Beginner's Guide to Investing: How to Start Smart, but where do you start? The biggest misconception about investing is that it's only for the elite and that you need a lot of money to start investing. That you need a lot of money to begin investing. This may have been true 10 years ago, but not in 2020. Advancements in technology and industry have removed all barriers to entry. Thanks to all these advancements, there are no more excuses for beginners not to invest, practice, and build wealth. But before you start, subscribe to our channel. We'll provide you great content every day. And don't forget the bell notification icon. Let's begin. Let's start with the numbers. 1. The golden rule of investing. The golden rule of investing is that you should never lose money. That's the rule. This rule was created by investment guru Warren Buffett himself. It was created by him. The best way to do this is to invest at attractive prices when the option's value is low. This way you can invest at a price below its actual worth. Taking risks is fine, but try to only take calculated risks. Avoid short-term investments because they are risky, and seek long-term investment options that offer safe returns to minimize risk. To minimize risk, seek long-term investment options that offer safe returns. Warren Buffett built his wealth by investing long-term rather than short-term. He built his fortune by investing long-term. While some people have made a lot of money speculating, others have lost a lot of money doing the same. Lost money the same way. Short-term trading involves numerous costs in the form of commissions and a lot of uncertainty. Can lead to massive losses. Many other billionaires have made gains through long-term trading. Long-term trading is becoming more and more important every passing year. 2. Portfolio planning. In other words, how much money do you want to make in the long run? What do you want to achieve financially? How much do you want your net worth to be? Ask yourself these questions in advance and make a plan to get there. Once you've done this, identify profitable investment options and check if the rate of return on those options will deliver returns for you. Based on this rate of return, choose the investment option that will give you the returns you want to achieve over the time frame you've set. Use this data as a guide for your investment decisions. 3. Paper trading. Paper trading allows beginners to get real experience without risking real funds. This approach allows you to trade and invest in stocks, log gains and losses, and essentially it's done the same way as in real life. Many platforms today allow you to practice for free. Before investing real money, consider it as a training ground. All beginners should start here. 4. Stocks. As a beginner, buying shares of a company is one of the best ways to invest your money. By investing in the right company, you can earn up to 15% per year. The strategy we're about to show you is the same one Warren Buffett has leveraged the market with for the last 60 years. It's the same strategy Warren Buffett has leveraged for the last 60 years. How should beginners invest? The most important thing is choosing the right company and the right timing. It's about choosing the right timing. To do this, you need to study the chosen company's past performance, management team, financials, moat, etc. If you find a company that meets the eligibility criteria, don't invest right away. Don't invest immediately. Put the company on your watch list for some time. Meanwhile, watch for the stock price to drop. Buy when the stock price falls. This way, you can get a great deal and profit if the company returns to its true value. It's important to keep emotions in check when investing. Remember that markets are highly volatile and even the best companies can have negative performances. Keep in mind that you might face. Don't panic and don't make rush decisions based on quick changes. Instead, patiently wait and analyze the situation before making a decision. Fear should not be the driving force of a buy or sell decision. Often, but not always, we make the wrong decision and do what the market wants. In the end, you do what the market wants. The beauty of investing today is that it doesn't require a lot of money. You can start with $1,000 and grow your account to tens of thousands of dollars in no time. You can increase up to when investing. Try to avoid penny stocks. Penny stocks are stocks of companies valued at $5 or less. These stocks may seem appealing because of their low price. However, they are volatile and there is little to no information about the companies online. Most penny stocks belong to relatively new small companies. 5. Investing apps technology can save beginner investors. More precisely, it can save beginner investors. There are numerous investment apps for beginners these days. Some even aggregate your credit or debit purchases and invest them in ETF portfolios. Others still invest in an ETF portfolio. These apps act as Robo Advisors and manage your portfolio for you. If you still want to do it yourself, there are many apps that will teach you how. There are also many apps that teach how to invest. Most apps cost next to nothing and are convenient as you can access them anytime from your device. Convenience. 6. ETFs exchange-traded funds are very similar to index funds. They are very similar to index funds. They are tied to a specific market index and employ the same investment approach. These funds tend to have lower fees compared to mutual funds. The main difference between the two is that instead of having a minimum investment, ETFs trade throughout the day and the stock price fluctuates. The stock price represents the minimum investment into the ETF and can range from under $100 to over $300. The stock price can be under $300 or over $300. ETFs are traded daily like stocks and are therefore subject to brokerage commissions. Many people have made good money with ETFs, but ETFs require a lot of research and caution. Caution is needed. To really succeed, you need to dedicate a lot of time to it unless you're a full-time investor. If you're not a full-time investor, you need to dedicate a lot of time to it. 7. Index funds. A simple definition of an index fund is that it's a mutual fund that runs on autopilot. They are mutual funds that run on autopilot. Index funds are a great alternative to hiring a portfolio manager to create an indexed fund for you. Index funds are instead tied to a specific index. A market index is a basket of investments that represents a segment of the overall market. A good example is the S&P 500, which contains stocks of the top 500 US companies. These are US companies. The S&P 500 funds mirror the performance of companies within their category and buy stocks of those companies. The fund buys stocks of those companies. The expenses are lower because the fund takes a passive approach to investing. Tracking a market index rather than employing an actual professional portfolio manager. Similar to mutual funds, investing in an index fund means buying a slice of the entire market in one transaction. In one transaction, you buy a slice of the entire market. In most cases, index funds require a minimum investment amount, while some broker-sold funds do not require a minimum investment. Index funds do not have a minimum investment amount. What a surprise! This investment option is excellent for the long term. 8. Target date mutual funds. Just like retirement plans, target date mutual funds also exist. These also exist. This investment option automatically invests for you, factoring in the year you plan to retire. A mutual fund is a basket of many investments where an investor purchases shares of the fund. This way, they invest the fund's entire pool of money in one purchase. These funds are managed by professional managers who decide how to invest the funds, but each fund typically follows a specific theme. For example, equity mutual funds invest in stocks. In most cases, Mutual funds hold a mix of bonds and stocks. If you plan to retire in the 2020s, you can choose a target date mutual fund accordingly. It will be indicated in the chart below. At the end of the investment period, the investor can collect the returns on investment. 09. Robo Advisors. As the name suggests, these are robots. As the name suggests, these are robots. They provide financial services like portfolio construction and investment option selection. They create portfolios and select investment options on behalf of people. If you're not an investment expert, a robo-advisor is a great option. Robo-advisors use computer algorithms to manage all the investments. Their systems have reduced overhead costs, so their trading fees are relatively lower compared to fees charged by brokers to manage your investments. It's better than hiring a broker to manage your account. Robo-advisors charge fees ranging from 0.25% to 0.50%, with additional fees ranging from 0.5% to 5% if you hire a personal financial advisor. If you're a beginner with not much money, this is an easy solution. But that doesn't mean you should leave all the work to your financial advisor. You need to track where your money is going and what's happening. If you're interested in learning, some advisors have educational content and helpful tools available. Some advisors have helpful tools. It's a more economical, convenient, and proven way to invest. 10. Company retirement plans or 401ks are a great starting point for investment beginners. For beginner investors, it's best to start with a retirement plan. At some companies, if you contribute 2% of your salary, the company will match another 2%. If you contribute 2% of your salary, the company may also contribute an equivalent 2%. It may seem like a small amount, but it's free money that will grow over the years. Currently, the maximum amount you can contribute to a 401k is $19,500, or $26,000 if you're over 50. You can contribute a maximum of $20,000. The advantage of this investment plan is that there is no minimum deposit required. You can start with the bare minimum. When you enroll in a plan, the amount is automatically deducted from your paycheck. Most retirement plan deductions happen pre-tax, so you save more in the long run. In the long run, you save more. The power of compound interest also plays a big role in growing your money. If you contribute a small amount each month, compounding will make you save a lot of money in just a few years. With compound interest calculation, you're still not sure? Check with your HR department. In general, if you follow this simple investing guide, you shouldn't have any issues. That said, where would you start your investment journey? Let us know in the comments. We'd love to know which option you think is best for you. That's it for today. Share this video with your friends and family. If you liked it, let us know you liked it. We'll do better next time. Hit the bell icon to notify us whenever you upload a new video. Hit the plus icon. For now, that's all. Wishing you success in your investment journey. Until next time. What was your experience with the topic covered in this video? Tell us about it in the comments, we are curious to know. And if you have any doubts or questions, don't hold back. Leave a comment, even just a simple like would be perfect, but most importantly, subscribe to the channel to stay informed about upcoming releases.